If you add 200,000 naira, 500,000 naira, or even 1 million naira right now, sitting in your bank account, what would you do with it? Would you buy shares from popular company like GT Bank or Dangote Cement, or will you either put the money into mutual fund and let someone else manage the money for you? You see, a lot of Nigerians want to invest, but many don't even understand where to start from. You hear things like buy stocks. You hear things like do mutual funds. You even hear go for treasury bills. But when you ask, what is even the meaning of all these investment times? People just give confusing answers. So today, I want to explain it in details. Welcome back to this channel. If you are a new viewer, you are welcome. This is where we break down investment matters. I try to explain in the most simple way so all my viewers can understand. Please join this community by clicking on the subscribe button. You're welcome. Now, we will compare stock investing and mutual funds in today's video. We will look into how they work, their risk, and if you are just starting out in Nigeria, you will learn step by step. And by the end of this video, you will know which one to choose, whether to use your money to buy shares, to buy stocks, or to invest your money in mutual funds. So let's start from stocks. You are literally buying part of a company. It is like you are becoming a part owner of this giant company. Now, if this company is Dangote Cement now, or this company is MTN Nigeria, and you buy, maybe you buy 1,000 shares of this company, you are literally a shareholder and owner of that company. So no matter how many shares of the company you are holding, you are also a co-owner, you are a shareholder. So you got to collect dividends, you got to collect profit. When the company makes profit, some of the profits are shared to other shareholders as well, just like you, if you are holding the shares. Let's say you buy 200,000 naira worth of a company, 200,000 naira worth of a company, and the company grows, the company open branches. Take for example, let's say you buy 200,000 naira worth of GT Bank shares, that is GT Co, and they open new branches, they grow, they make profits, or their service improve. The value of your shares will likely go up. And when it go up, maybe you sell part of those shares, that is capital gains. That means when share increase in price, you make profit. And when they are sharing dividends, you also collect. So you are making money in two ways. That is for shares. If you owe 200,000 naira and the price go up like 50%, that means you are making extra 100,000 naira on top of your money. But there is a catch, because stock prices can go up or down. Today you might see 200,000 naira. Tomorrow your 200,000 naira might be worth 180,000 naira or even lower. That is because prices of stocks change every day based on market news, based on company results, and sometimes even global events. Global events can cause a fall, a drop in prices of stocks. For example, when the economy is tough, people panic and sell their shares and prices drop. But when the economy picks up again, the value of the share also increases. And sometimes when the company announces big profit, price will also rise. So stock investing is not for the faint-hearted. You need to be patient. You need patience, you need courage, and you need to wait for long term if you are investing in stock. If you are investing in stock, you must have a long-term mindset, because while stocks can make you rich over time, they can also make you lose part of your money in the short term. Now, let's talk about mutual funds. Imagine a big money basket where thousands of people, a lot of people put money into this basket, I am explaining this for beginners so you can understand. Then a professional called a fund manager takes that money and invests it in different places like stocks, like treasury bills, like bonds. So instead of you trying to pick stocks, trying to research about stocks, just as I explained earlier, the fund manager will pick those stocks for you and carry all this money inside this basket. Don't forget, this money belongs to many people. That is why it is called pool of fund. Pool of fund. Thousands of people put their money here. So when the fund manager carries all this money and invests it in all the assets, stock, treasury bills, and bonds, and when these baskets make profit, each person that puts money here will now get percentage of profit based on how much they contributed inside this pot. So you don't have to pick anything yourself. The fund manager does it for you. Because this fund manager already have knowledge. They have the knowledge, they have the experience, they have the research too. They have everything to make sure that this money inside this basket becomes profitable. And for you to join this mutual fund, for you to invest in it, you don't need big money. Some mutual fund in Nigeria let you begin with as little as 5,000 naira. If you watch my video, the video posted about the Stanbic IBTC, about different type of mutual fund in Nigeria, I give details on each mutual fund where you can join with 5,000 naira or 10,000 naira. That is one of the biggest advantage because it has a low entry and it has a low stress. There are different types of mutual funds. So if you watch my video about mutual funds, you will learn all the types of the mutual funds. So mutual funds are like all in one package. You get diversification, you get a professional management, and you have a less daily stress. You don't have to panic if one stock go up or one stock go down because professionals are managing the money for you. Now that you understand a bit of stocks and mutual fund, now let's make a comparison. Let's compare both of them properly so that you can make your investment decision. Now, when you buy stocks, you are doing it on your own. Here, you are on your own here. So there is no professional, nobody's managing it for you. You make the decision. You decide which company to buy, when to buy it, and also when to sell. You carry all the full risk. The full risk is on you if you buy it on yourself, but you also enjoy the full reward. So here, you bear the full risk if you are buying the stocks on your own, and you also enjoy the full reward. Either your stocks become 5x, maybe your stock become 5-fold of how much you buy it, you enjoy all the reward yourself. Whether you buy it for 100 naira and it's become 50 naira, you also bear the entire loss yourself. Now, when you invest in mutual funds, you hand that responsibility to professionals. So here, you don't manage things on your own. You are not on your own here. Your money now in charge of the professionals. They manage everything. They will research for the stock to buy. They will do their fundamental analysis. They will buy and sell. You only just check. You check on your performance. You just check your returns every day. Most mutual fund accounts allow you to see the progress of your money every day, every week, or months. So the difference here comes down to control versus convenience. Control. Do you have the control of your assets? What about the convenience? It is not everyone that have the time to check prices of stocks. As this stock go up, as it go down, it is not everyone that have that time to do that. Some people just want to give their money to a professional that, oh, manage this money for me, and I want to see how much I'm earning. Stocks gives you control. If you want to have control of everything, if you want to know how everything is going, you want to manage your money yourself, stocks gives you control, but they require time, research, and your understanding. So if you have time here, if you can research and you understand the market, I think it is not bad if you manage it yourself, if you buy the stock yourself. Mutual fund also gives you convenience, but you pay small management fees for that service. Most mutual fund manager collect 1.5% management fee. 1.5% might not be a big money, but when your investment is huge, if you are investing a lot of millions, 1.5% might be something. But let's talk about returns. Stocks have the potential to give higher returns because you are investing directly in companies. This one can give you much more higher returns because you are doing it directly, and every returns that comes, you own everything. But mutual funds tend to give more stable. It might be low, but it is stable. You know, mutual fund used to have yield and rate. Some can say we are only giving 18% per annum. So even if the stock price performs so well, you might not get more than 18%. Even if you got more than 18%, it might just be a little higher in some mutual funds. But the returns are steady because they are diversified, meaning they put the money into many assets, into many things. So let me say stocks give higher risk, and also higher reward. Mutual funds, lower risk and also lower and steady returns. Lower and steady returns. Depending on which one you want to go for, either you are doing the stock or you are doing mutual funds. Okay, now let's talk about which one is better for you. See, the honest truth is there is no one size fits all. It depends on your personality, your goals, and your patience level. If you are someone who doesn't have time to study the market, you don't like checking stock prices every day, and you prefer peace of mind, mutual funds is just the right asset for you to invest in. If you don't have time to check anything, mutual fund might be your best bet. You will still grow your money, but with less stress. However, if you enjoy learning, you can handle risk, and you are patient enough to wait for years for your money to grow, stocks might reward you. So if you don't have time, go for mutual funds. If you can wait, you want bigger reward, but you can wait, stock is the best bet for you. But for me, the smartest approach, you should combine both. You can keep, maybe, let's say you want to invest 1 million naira now. You can keep, let's say, 500,000 naira in a mutual fund, 500,000 naira in stocks. Or you can let the bigger part be in the mutual fund, maybe 70%, 700,000 naira in a mutual fund, 300,000 naira in direct stocks. So you just divide your money, 300,000 naira, you go to stocks, then 700,000 naira, you go to mutual fund. So by doing this, you combine both. Part of your money grows safely, while other part chases higher returns. That is how most wealthy investors do it. They balance risk and reward. At the end of the day, the goal is simple. We don't allow our money to sit idle. Whether it is stocks or mutual funds, just make sure your money is working for you. Thank you again for watching these videos today. Let me know in the comments which one you are currently doing. Are you into mutual funds or you are holding some stocks? Thank you again. Share this video, subscribe and like. I'll see you in my next video.